Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Serina Therapeutics.
If you find our talks useful, please consider subscribe, like, and comment underneath. So to kick things off, I want you to imagine paying double the sticker price for a used car that is, well, currently engulfed in flames.
Right, which sounds completely insane.
Exactly. It defies all basic financial logic. I mean, you would never willingly pay a massive premium for an asset that looks like it's about to be reduced to ashes.
No, of course not.
But today, we're looking at a group of highly sophisticated investors who did exactly that. They bought into a clinical stage biotech company that was teetering on the absolute brink of collapse.
It's just a remarkable scenario. You know, when you spend enough time looking at market data, you get used to seeing distressed companies slowly fade into irrelevance. The market is usually incredibly efficient at pricing in despair.
Yeah, usually. But what happened here is a complete structural rewrite of a company's financial trajectory, seemingly overnight. And that's our mission for today's talk. I really want you, the listener, to picture the reality of this company prior to this month.
It was grim.
Extremely grim. We are talking about a business with zero meaningful product revenue. They're carrying an earnings per share of negative $1.87.
Right, and the stock had been just hammered down.
Oh, absolutely crushed. It was trading near its 52-week low of $1.22. And remember, this is a massive fall from its high of $7.92.
So at those lows, the entire company had this tiny, almost non-existent microcap valuation of somewhere between $14 and $18 million.
Which is a really dangerous neighborhood to be in, right?
Oh, very dangerous.
Yeah.
When a company's market cap shrinks down to $14 million,
Yeah.
institutional investors are usually forced to just abandon ship.
Because of their internal rules.
Exactly. It falls below their minimum sizing mandates. So that leaves everyday retail investors holding a highly illiquid, heavily declining asset.
But it actually gets worse before it gets better. If you looked at their balance sheet, they were reporting a negative free cash flow of roughly $11.98 million.
Wow. Alongside a staggering debt-to-equity ratio of 181%.
Wait, stop right there. $12 million in the red, with liabilities completely dwarfing their actual equity.
Yeah.
For a company valued by the market at only $14 million, how were they not already bankrupt? I mean, how does a company even keep the lights on with that kind of math?
Basically, they survive on credit, fumes, and, the hope of a miracle. In the clinical stage biotech sector, when you're pre-revenue, having a debt-to-equity ratio of 181% is essentially a financial death watch.
It's just a massive red flag.
Right. It tells the broader market that you are borrowing heavily just to fund your daily cash burn, and you have no incoming revenue to actually service that debt. The market had essentially priced in an imminent delisting or a bankruptcy filing.
But then the miracle actually happens. The shockwave hits. Serina announces a private placement financing of up to $30 million.
And this isn't just a rumor. This is a concrete deal.
Right. It's structured in two $15 million tranches, with the first expected to close today, actually March 20th, 2026.
And the market reaction to that was just instantaneous. I mean, it was explosive. We saw this massive influx of volume causing a 46% surge in after-hours trading.
Rocketing the price from a $1.28 close all the way up to roughly $1.87.
Yeah, which triggered inclusion on all these lists for top movers and unusual volume.
So it looks like a classic short squeeze combined with a relief rally, establishing a new support floor somewhere around the $1.80 to $2 range.
Right.
But here is the critical question. From a purely fundamental level, does an injection of cash actually fix the underlying business, or is it just, delaying the inevitable collapse of a flawed company?
Well, in this specific case, it fundamentally fixes the immediate existential threat. Management has actually gone on record stating that this capital injection extends their cash runway deep into the second half of 2027.
Oh, wow. So that completely invalidates those near-term solvency concerns.
Completely. But more importantly, they aren't just using this money to pay off old debts and, sit on their hands. This $30 million specifically funds the company through a critical value inflection point for their main product.
Meaning they're fully capitalized to execute their clinical trial.
Exactly.
Okay, so the bankruptcy threat is gone. But survival isn't the same thing as value. Nobody steps in to pay a massive premium just to keep the lights on for a struggling research team. They must be looking at the pipeline.
They absolutely are.
So what exactly is the drug that justified this sudden financial rescue?
To understand the premium they paid, we have to look at the severe medical need they are trying to address here. So, Serina's lead candidate is called SER-252, and it's targeting advanced Parkinson's disease.
And Parkinson's is an incredibly difficult, complex neurological condition. Honestly, the current standard of care leaves a lot to be desired.
It really does. So, Parkinson's involves the progressive loss of dopamine-producing cells in the brain. The standard medical response is to use a dopamine agonist.
Which is a drug that mimics dopamine to stimulate the brain, right?
Exactly. And Serina is using a very well-known established drug for this called epomorphine.
But wait, apomorphine is already on the market, isn't it? If you talk to patients utilizing current epomorphine treatments, the delivery methods are often pretty brutal.
Very brutal.
You're dealing with intermittent injections or these cumbersome mechanical pumps that you have to carry around.
Right, and that mechanical delivery flaw creates an absolute biological nightmare for the patient. Because the drug isn't delivered steadily, patients suffer from severe fluctuations.
Like roller coaster effects.
Yeah, exactly. When the drug spikes in their system, they often experience severe dyskinesia.
Those are the intense, involuntary, erratic movements, right?
Yes. But then, the drug wears off abruptly. The levels drop, and the patient experiences a freezing episode. They suddenly feel trapped in their own body, completely unable to move at all.
That sounds terrifying. So the goal here isn't to find a new chemical to treat Parkinson's. The goal is simply to figure out how to put a steady, unbroken stream of the existing drug into the body so you eliminate those wild spikes and terrifying drops.
Precisely. And that is where Serina's primary competitive advantage comes in. They have this proprietary delivery platform called POETIC.
POETIC, what does that actually stand for?
It stands for polyethylene glycol oligomer therapeutic innovative composition.
Okay, quite the mouthful. How does POETIC actually work in the body?
So think of the POETIC polymer like a microscopic sponge that is completely saturated with the apomorphine. When you receive a subcutaneous injection of SR-252,
Meaning it's injected just under the skin?
right, just under the skin, you aren't dumping the liquid drug directly into the bloodstream like a normal shot. Instead, you're basically placing this microscopic, drug-filled sponge under the skin. And over time, the polymer naturally and predictably degrades.
Okay, I see.
As it breaks down, it leaks a perfectly steady, continuous drip of apomorphine into the patient's system.
So it essentially acts as a biological time-release valve, smoothing out the entire experience. You avoid the dyskinesia because there's no sudden spike, and you avoid the freezing because the sponge never stops dripping until it's fully dissolved.
That is the exact mechanism. And because they're solving a mechanical delivery problem rather than a fundamental biology problem, it drastically changes their path through the FDA.
How so?
Serina is utilizing the 505(b)(2) new drug application pathway, and their investigational new drug application is already cleared to proceed.
The 505(b)(2) pathway, I mean, it sounds like bureaucratic jargon, but for biotech investors, that string of numbers is essentially the secret sauce of this whole investment thesis.
Oh, it's huge.
Can you explain why that pathway is such a massive advantage compared to normal drug development?
Yeah, the 505(b)(2) pathway is honestly a stroke of structural genius for a smaller biotech. In standard drug development, if you invent a brand new chemical, you have to spend years and tens of millions of dollars just proving that the chemical won't severely harm the patient long before you even check if it cures the disease.
Right. Safety first.
But the 505(b)(2) pathway allows a company to submit an application where a significant portion of the safety and efficacy data comes from studies conducted on previously approved drugs.
Oh, so because apomorphine has been utilized and studied for decades, the FDA already knows the active chemical works for Parkinson's and is generally safe.
Exactly. Serina doesn't have to reinvent the wheel here.
They get to skip the most grueling, expensive, early phases of chemical safety testing.
Yes. They only have to prove that their specific microscopic sponge, the POETIC continuous delivery method, is safe and performs better than the old clunky pumps and injections.
Which makes the entire development cycle faster, significantly cheaper, and structurally de-risked compared to starting from scratch with a novel molecule.
Absolutely.
Okay, so that structural de-risking explains the science side of things. But to really grasp the momentum of this stock, we have to transition back to the finance. We need to look at who is writing the checks because the terms of this $30 million deal are wild.
They are highly irregular for a distressed microcap, but in the best possible way.
So the shares in this placement were priced at $2.25. Let me remind you, the stock had closed at $1.28 before the news.
Right.
That means these investors voluntarily paid a 68% premium to the prior closing price. But even more shocking, the warrants attached to this deal were priced at $5.
Which is incredible.
That is a 273% premium. I want to pause on the word warrants for a second because $5 is a massive number in this context. Explain to me what an investor is actually signaling when they accept a warrant at a 273% premium.
Well, a warrant is fundamentally a contract, right? It gives the investor the right to buy more shares of the company at a specific, predetermined price in the future. In this case, that price is $5.
And if the stock never hits $5,
If it never reaches $5, that warrant is essentially a worthless piece of paper. So, by accepting a deal structured around $5 warrants, these highly sophisticated investors are signaling massive conviction.
they're putting their money where their mouth is.
Exactly. They are effectively saying, we believe the data from this clinical trial will be so strong that this stock will easily blow past the $5 mark, making our right to buy shares at that price incredibly valuable.
Which is a stark contrast to how distressed financing usually works, right?
Entirely. Normally, when a $14 million biotech with massive debt needs cash, the institutional lenders are downright predatory.
They smell blood in the water.
They do. They know the company has a gun to its head, so they demand steep discounts, often 30 to 40% below the current market price.
So to see a syndicate voluntarily pay almost double the market price for shares and accept warrants at nearly triple the price is just a flashing neon sign to the rest of the market that the current valuation is severely disconnected from reality.
Exactly. And it's not just faceless, anonymous institutional money making this bet. This deal is being spearheaded by a very specific, highly visible individual in the biotech space, Greg Bailey.
Right, Greg Bailey. He is a renowned biotech dealmaker, and he isn't just acting as a passive investor here. He is stepping in as the co-chairman of the board for Serina.
Yes.
For those who might not be deep into the weeds of biotech mergers and acquisitions, Greg Bailey is famous for his pivotal role in selling a company called Biohaven to Pfizer.
Which was a massive deal.
This feels a bit like a legendary real estate developer buying a rundown, dilapidated house for 68% over the asking price, and then immediately nailing his nameplate to the front door. Suddenly, every other investor in the neighborhood is looking at that house, wondering what gold is buried in the basement.
That's a great way to put it.
Does his history with Pfizer naturally fuel M&A or partnership speculation for Serina?
It absolutely pours gasoline on that speculation, and for very sound structural reasons. If you zoom out and look at the broader pharmaceutical landscape, the massive large-cap pharma companies are constantly battling something called the patent cliff.
That's where their exclusive rights to sell blockbuster drugs expire, and generic competitors just flood the market, wiping out billions in revenue overnight.
Right. They desperately need new products to replace that evaporating revenue. But discovering and developing a completely novel, from-scratch drug takes a decade, costs billions of dollars, and has a failure rate of roughly 90%.
It's incredibly risky.
So rather than risking it all in their own labs, these giants go shopping.
They look for smaller companies that have basically done the hard work for them.
And that is why a company like Serina, armed with a de-risked 505(b)(2) pathway and a proven M&A dealmaker like Bailey at the helm, becomes a prime speculative target. Large pharma companies love acquiring 505(b)(2) assets.
Why is that?
It allows them to take an existing therapeutic category they already understand, slap a superior delivery mechanism on it, and patent it as a brand new exclusive product. They extend the life cycle of the drug category without absorbing the devastating cost and risk of novel drug discovery.
That broader industry dynamic really contextualizes some of the aggressive analyst coverage we've seen. Like, an analyst from H.C. Wainwright had previously maintained a buy rating on Serina with a $15 price target projected for late 2025.
A $15 target on a stock that was sitting at $1.22 just a few days ago. That's wild.
It implies a monumental upside. But that $15 target clearly assumes the flawless execution of this upcoming clinical trial and the eventual realization of that M&A or partnership buyout.
Yes, it does.
And the premium paid by Greg Bailey's syndicate acts as a loud signal validating that thesis.
It does. However, as critical thinkers, we cannot just look at the upside. We have to examine the structural reality of the deal. Every setup has a bear case, and the risks here are highly specific to the mechanics of microcap investing.
Okay, let's tackle the most obvious, glaring risk first, dilution. They are printing millions of new shares and pre-funded warrants to raise this 30 million. The pie is suddenly being sliced into twice as many pieces.
Right.
So if you are a retail investor holding shares from before this deal, your individual slice just got significantly smaller. How can a deal that mathematically dilutes the existing shareholder base be viewed as a bullish catalyst?
It's a vital question. And it comes down to a crucial distinction in corporate finance. The difference between toxic desperation financing and accretive financing.
Let's break those down. What does a toxic financing actually look like?
So, toxic financing is the death spiral. It's when a distressed company issues heavily discounted shares or convertible debt just to pay their electric bill and keep the doors open for 3 more months.
Right, survival mode.
Exactly. It
Yeah.
destroys shareholder value because the new money doesn't fund growth or development.
Yeah.
It just funds bare minimum survival, usually requiring them to come back and dilute the stock again and again.
But because this deal was executed at a massive premium, it changes the math.
Exactly.
Sure.
This is highly accretive financing. The $30 million being raised isn't just plugging holes in a sinking ship. It is specifically earmarked to fund a high-potential registrational study from a position of absolute strength.
Okay.
Yes, mathematically, the share count is increasing, but the strategic value that this capital unlocks, the ability to definitively prove the efficacy of SER-252, far outweighs the dilution. The pie is being sliced into more pieces, but the capital infusion is expected to make the total size of the pie exponentially larger.
Okay, so the premium justifies the dilution. But we also have to address the volatility. This is a microcap stock with a historically low float, meaning there aren't that many shares available for public trading.
Which means it is highly susceptible to violent swings. Any major shift in sentiment or, a large fund moving in or out of a position can cause the price to gap up or crash down in minutes. It is not an asset class for the faint of heart.
And finally, there is the clinical execution risk. We've talked about how the 505(b)(2) pathway de-risks the chemical safety of apomorphine. But de-risked does not mean zero risk. SER-252 is still only in phase 1b clinical trials.
And that is the binary reality of the biotech sector. You are ultimately betting on the biological data.
Right.
While the apomorphine is proven, there is no absolute guarantee that the POETIC delivery system will perform flawlessly when scaled up to a wider, diverse patient population. What if the degrading polymer causes unexpected severe reactions at the injection site?
Or what if the continuous delivery mechanism doesn't actually translate to a statistically significant improvement in reducing the dyskinesia and freezing episodes compared to the old pumps?
Exactly. If the sponge doesn't work the way it's supposed to, the trial fails. And if the trial fails, the primary asset goes to zero and the valuation collapses, regardless of who is sitting on the board of directors.
That is the uncompromising truth of clinical research. The data will dictate the ultimate value, which gives us a very clear, defined roadmap for what to watch next. Let's synthesize the timeline for the listener. Based on this fundamental shift in their balance sheet and the technical breakout on the chart, the target horizon here looks like a swing to medium-term hold, roughly in that 6 to 12-month range.
That aligns perfectly with the schedule of catalysts. The immediate event is the market absorbing the new share issuance from the first $15 million tranche, which is scheduled to close today, March 20th, 2026.
Right.
And once the dust settles on that technical absorption, all attention will pivot to the first quarter earnings report.
Because that Q1 2026 earnings call will be management's first opportunity to publicly lay out their exact fully funded roadmap now that the bankruptcy threat is dead.
And then comes the true test, Q2 of 2026. That is when the company is expected to provide updates on the phase 1b dosing and eventually the initial clinical data readouts.
They've already successfully enrolled their first patient, haven't they?
They have. As the safety and tolerability updates begin to roll in, each positive milestone acts as an incremental catalyst. The market will use that data to slowly build the case toward that aggressive $15 price target.
It is an absolutely fascinating turnaround story to go from a suffocating debt load and a collapsing share price to a fully funded registrational trial backed by serious biotech heavyweights paying a massive premium. It is a masterclass in how rapidly the narrative can change.
It certainly proves that in the microcap space, paying close attention to the specific mechanics of how a company raises its money can be just as important as understanding the science they are trying to fund.
A vital lesson for anyone analyzing this sector. Before we wrap up today's analysis, I want to leave you, the listener, with a broader concept to mull over. Think about the sheer disruptive power of that 505(b)(2) regulatory pathway we
What
discussed.
a game changer.
Truly, if a tiny clinical stage company can bypass years of high-risk, multi-billion-dollar R&D simply by using a polymer sponge to reformulate and continuously deliver an already approved drug, how many other forgotten, flawed, or heavily side effect-laden drugs are sitting out there in the medical archives right now?
That's a really interesting question.
How many older treatments are just waiting for a smart company to invent a new delivery method and unlock their billion-dollar potential?
It forces you to rethink what medical innovation actually looks like. Sometimes the most profitable breakthroughs aren't about discovering a new chemical, but simply building a better vehicle for an old one.
A completely different lens to view the pharmaceutical industry through. Thank you for joining us for today's talk. Keep questioning the headlines, look closely at the terms when the big checks are written, and we will catch you on the next one.